Part 1. Accumulation and Trend Markup Phase. The crypto market moves in cycles, and understanding these cycles is crucial if you want to position yourself ahead of the crowd. One of the most powerful insights in trading and investing is recognizing when smart money is building positions. These early moves set the stage for profits, while retail investors often react too late. The first phase of the crypto market cycle is accumulation. During this phase, prices are low and volumes are muted. Smart money, institutions, experienced traders, and strategic investors quietly builds their positions without drawing attention. Retail sentiment is usually bearish. Many investors are skeptical or fearful, believing the market has little upside. This creates an opportunity for long-term investors. By entering early, they can maximize returns over the next cycles. Accumulation is often subtle. Unlike the explosive gains seen later, this phase is almost invisible to the average trader. The market may appear stagnant and news headlines are often negative. But underneath the surface, smart money is quietly accumulating assets, preparing for the next move. The key here is patience. Investors who understand accumulation avoid emotional trading and set themselves up for compounding gains over time. After accumulation comes the trend or markup phase. This is when the market begins to awaken. Prices start to rise, optimism returns, and early speculators profit from the moves that smart money initiated. Retail gradually begins to participate, adding liquidity and fueling further upward momentum. News coverage improves, sentiment shifts, and the market gains attention. The markup phase is exciting but requires careful observation. Knowing when this phase starts can make a significant difference. Entering during the early trend allows you to ride momentum while avoiding the emotional swings that occur when retail FOMO sets in. During this phase, technical indicators may start signaling strength, but understanding smart money positioning is key. Institutions and experienced traders often set buy levels and key support zones, quietly guiding the market while public interest slowly grows. This phase also shows the first signs of market psychology shifting. Retail investors begin noticing gains, and stories of early profits circulate on social media. This is the point where liquidity increases as more people start entering positions. The trend can continue for weeks or months depending on market conditions, and understanding the difference between smart money and retail behavior is essential. Recognizing accumulation and markup phases is the foundation of consistent trading. Investors who master these stages avoid chasing hype and can position themselves for long-term success. By observing volume, sentiment, and price action, you can anticipate the trend rather than react to it. In Part 2, we will explore the euphoria and distribution phases, where the market reaches its peak, FOMO dominates, and smart money quietly takes profits. Understanding these stages is essential for avoiding buying at the top and protecting your capital. Part 2. Euphoria and distribution phase. Once the markup phase gains momentum, the market eventually enters the euphoria phase. This is the peak of risk-on sentiment, the point where everyone talks about crypto, and FOMO dominates. Prices surge rapidly, and trading volumes skyrocket. Social media buzz, headlines, and mainstream coverage create a sense of inevitability. Many believe the market can only go higher. Euphoria is exciting but dangerous. It's when retail investors, often driven by greed and fear of missing out, enter late. Smart money, however, begins to distribute positions quietly. Institutions and strategic investors take advantage of the frenzy by selling into the heightened demand. This phase demonstrates a key principle. Market tops are usually formed when everyone is overly confident, not when everyone is fearful. During euphoria, it's easy to get caught in the hype. Stories of massive profits encourage emotional buying, and technical indicators may appear extreme. But experienced investors understand that the peak is not just about price. It's about market psychology. Retail buying pressure reaches its maximum, while smart money strategically exits positions without alerting the public. The euphoria phase eventually transitions into the distribution phase. Here, insiders continue selling into bullish sentiment while retail investors are often unaware of the shift. Prices may still rise slightly, but the momentum is slowing, and volume patterns can reveal subtle signs of distribution. Recognizing distribution is critical. Investors who identify this stage can lock in profits before the market corrects. During distribution, retail investors often buy late, thinking the market will continue indefinitely. However, the shift in supply and demand becomes evident as prices struggle to move higher. Despite high interest, Smart money gradually offloads assets, taking advantage of latecomers. Those who fail to recognize distribution risk holding positions at the top, facing losses during the inevitable decline. Understanding euphoria and distribution is not just about timing, it's about risk management. By observing market behavior, liquidity, and sentiment, investors can protect their capital and optimize exits. This knowledge allows you to avoid emotional decisions, such as panic buying or selling at the wrong time. In the next video, part 3, we will dive into the decline or risk-off phase. This is when the market corrects, panic selling emerges, and liquidity tightens. We will also discuss how cycles repeat, how Bitcoin often signals early phases, and how investors can anticipate movements to position themselves ahead of the crowd. Part 3, Decline, Risk-off phase and cycle repetition. After the distribution phase, the crypto market enters the decline or risk-off phase. Corrections occur, panic selling emerges, and liquidity tightens. This is the phase where retail investors often feel the strongest fear, as prices drop sharply after the euphoria and distribution periods. The risk-off phase is essential for the market to reset. Prices fall to levels where accumulation can begin again. Strategic investors observe these declines as opportunities rather than threats. Understanding when to protect capital and wait for the next accumulation phase is crucial for long-term success. Emotional traders who bought at the peak often sell at losses, providing liquidity for the next cycle of smart money accumulation. One important lesson is that crypto market cycles repeat over time. Bitcoin often signals early phases, followed by Ethereum and other altcoins. By tracking these rotations, investors can anticipate market movements rather than chase trends. Smart money uses liquidity flows to position themselves ahead of retail traders, entering accumulation phases quietly and exiting during euphoria. Recognizing these signals can give you an edge in timing entries and exits. Applying these principles systematically is what separates consistent investors from emotional traders. By identifying accumulation, markup, euphoria, distribution, and decline phases, you can make informed decisions, manage risk, and maximize gains across multiple cycles. Observing historical patterns, sentiment shifts, and liquidity flows allows you to act strategically rather than react impulsively. Crypto cycles are not random. They are driven by human behavior, psychology, and liquidity. Investors who understand these dynamics can protect capital during downturns, profit during uptrends, and maintain a long-term perspective. Patience and discipline are key. In conclusion, mastering crypto market cycles is about more than just technical analysis or news. It's about understanding the phases of accumulation, markup, euphoria, distribution, and decline, observing smart money behavior, and timing your moves strategically. By doing so, you can position yourself ahead of retail sentiment, protect your capital, and take advantage of long-term opportunities. Subscribe to MacroCycleLab to learn how crypto cycles repeat, how smart money behavior shapes markets, and how to consistently position yourself ahead of the crowd for long-term success. Thank you for watching. What's your take on today's market? Share in the comments below. If this video helped you understand market cycles, like and subscribe for more insights from MacroCycleLab. See you in the next video.